Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
I was going through a complete re-education in what works in investing because I recognised that a lot of what I'd learned up to date hadn't necessarily been that beneficial for me, and I dove straight into all the behavioural finance side of it, as well as all of the more quantitative academic aspects of investing, which is something I hadn't got an education in when I was in the city or at Goldman's, but it's something I self-educated on because you started to find there was just so much free publication of academic papers. There were some great stock market classics.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. This is the 6th anniversary of the podcast. Where did the time go? During that time, I've had the privilege of hosting numerous insightful guests on this podcast, each bringing their unique perspective to the world of investing. This is a special compilation episode to revisit some of the most fundamental and classic valuation metrics that every investor should understand. Let's kick off with Richard Hemming from Under the Radar Report, as he discusses the forward-looking PE ratio and how future earnings forecasts can influence investment decisions. You're looking for value. I mean, this is what we're talking about here. And how can a beginner investor really work out what that value is? I mean, you mentioned the forward-looking PE. Let's just dig a bit deeper into that and what it is about that metric that really made you interested.
Well, I think the forward-looking PE is one thing, but also...
And this is different just to like the PE ratio. If you just look at a raw PE ratio...
Yeah, well, the forward-looking PE is the key because it's what the expectations... Generally, consensus with these big cap stocks, loads of analysts cover them. So your average PE, your average forecasts are going to be pretty good. You don't need to do that kind of scratching around yourself. It's all there. So your consensus forward PE is a pretty good guide.
And so that's what you're looking for, consensus forward PE.
You're looking for consensus earnings and the PE based on that. And you look at, okay, what multiple has this stock traded at over its lifetime? So its average multiple, what's it trading at now? That's generally a simplistic view of looking at it. So, okay, I know this product, I use this product. It seems to be going pretty well to me. Like this is the Peter Lynch factor. I use it. Therefore, like I bought Sydney Airport because I got sick of paying parking fees. At the Sydney Airport, I thought I've got to buy the Sydney Airport just to give myself a hedge against this. And that worked actually pretty well. Those dividends paid for it, which brings me on to, okay, you want to get a lower than average kind of multiple, all things being equal. What you also want to be aware of is where that 10-year bond yield is, because that is the key indicator for value. So the 10-year bond is, just over 4%. What kind of dividend yield are these guys paying me? So Commonwealth Bank is actually paying about the 10-year bond yield. What we've said, okay, you've got your forward PE, you generally want to be paying a lower multiple than they pay. And like the closer you get to that PE multiple of 10, the better off you're looking, because basically if you're all things being equal, if they achieve kind of market earnings growth, you could double your investment in 10 years. That's basically what a PE of 10 stands for.
So that 10, what are the components that make up that figure of 10?
Well, you've got what a PE is, it's simply like a quick and simple version of the forward earnings or the forward dividends that a company's making in today's dollars. So you've got E over K minus G. So E is your future earnings or your future dividends, and you're dividing that by your cost of capital minus your growth. So with a stock like BHP, like that might have a 10, and Wesfarmers or Westpac might have a PE of 10. But the difference is that basically the growth factor is going to be more consistent from Westpac than it is for BHP. So your variability is higher. So basically what you're saying is over time there's going to be a volatility of earnings, more so with BHP because it's relying on commodities prices than Westpac. But over time, the price that I'm paying is anticipating that I'm going to get an average of 10% return a year, which means that my money should, all things being equal, double over time. The lower the PE, the better value you're getting generally from a stock. And on top of that, as I said, what you want to do is look at the yield that these stocks are paying. There is more volatility from a dividend yield that you're going to get from BHP than from Westpac, but you have that benchmark of that 10-year bond benchmark of 4.1%. So even though you might be getting a higher dividend yield from BHP in the earnings at the current level, like 7% versus Westpac might be 6 or 5%, your uncertainty is greater about the future dividends for BHP than it is about Westpac.
And that's really worth noting, isn't it? Because if you just look at a dividend yield just on a statement, it's not telling you the whole picture, is it?
It's not telling you the whole picture, and the P factors in that volatility more than the dividend yield does. So it's a better litmus test for how expensive a stock is. It's a good proxy for what I said before, E over K minus G.
And this is the forward-looking PE, not just
the
a
forward-looking PE is always the key.
That's Richard Hemming from the Under the Radar report. Check the show notes for links to further information about him. Tony Kynaston is from the QAV Investing podcast. Here he talks about valuation based on company earnings. We also digress into impairment costs, explaining what they are and how they're reflected in financial statements.
The thing about share investing is it's not a straight line from the lower left to the upper right. It doesn't always go up, but in the long term it goes up. So it's the old adage of time in the market versus timing the market that's important.
It's the difficult thing, though, isn't it? The psychology and the emotions that you feel.
Absolutely.
It's these times when you do feel like throwing in the towel.
Yeah, no, absolutely. And I'm not saying it's not going to get worse before it gets better too. Who knows? I mean, if we had a crystal ball, we wouldn't need podcasts like this to talk about investing, but we don't. And what we can do is to have a framework for investing so it can take the emotions out of investing. And when we get to these situations where A, we don't know what's going to happen, B, it looks like it's all too hard, we can have a way of investing which we just follow and it can get us through these kind of tough times.
And in the QAV methodology, you're basically basing the numbers on whatever the latest report is.
Correct. The latest, either half yearly or annual.
And we've just come through the annual season, haven't
pretty
we?
Much, yeah. Yeah. So we look at, again, trying to take the emotions out of things. We look at the figures that were reported. Does the company have lots of cash? Are there certain quality metrics that it meets? And then can we buy at a reasonable price?
You just mentioned interest rates. Do you believe that interest rates are what's been driving market pricing at this stage?
Oh, interest rates always do drive market pricing because if you're a company that rents or leases space, your costs have gone up because interest rates have risen. If there's inflation going on, so that's part of why interest rates are rising, so that hurts other companies. So yeah, it's a big thing. Does it affect how I invest? Indirectly it does because it affects the economy, but directly no. We can still find good quality companies, probably even more so in a downturn like this, that have lots of cash and you can invest in for the future with them.
What's the importance of having lots of cash?
Well, I think the most important thing is that, if you've got a lot of cash, you're not really being affected by interest rates, are you? Because cash is separate to borrowing.
You're not paying interest.
Yeah, we're looking
costs.
for low debt in those kinds of companies as well. It's one of the metrics we go through and look at. So yeah, cash is always king. What Warren Buffett said it more succinctly. He said he looks for companies that can raise their prices at any type of environment in the market. So that's the kind of quality company he looks for. And those kind of companies have lots of cash on their books.
And it also means that they can survive through any kind of downturn.
Correct.
Like I believe during the COVID situation, there were a lot of companies, if they had a strong balance sheet, they were able to sail through.
Oh, absolutely, yeah. And I'm not saying that those companies their share prices still won't go down, but they will recover. And of course, the time to buy them is when the share prices are down too. So that's another important metric. We use an analogy called the coffee shop analogy. So if you think about a local coffee shop, and there's one up the road here, if they sell coffee at $5 a cup and they sell a certain number per year and they make a net profit of 10% on that, you can work out what that place is worth if you wanted to go along and make an offer to buy it. There'll be a certain number of years into the future you'll project that kind of cash flow for, and you do what's called a discounted cash flow back to what you want to pay for that stream of income, and you'll pay a certain price for that coffee shop. Now, if McDonald's opens across the road and has a McCafe in it and it's selling coffee at $3 a cup, then the coffee shop that we bought when things were good will be worth less because they're going to have to try and match the competition across the road. So no more $5 cups of coffee. And they're also going to sell less because there's now a competitor in the market. So, what may have been, I don't know, I'll just pick numbers here, $1 million investment is now worth $800,000 or $700,000 or whatever the number is, simply by discounting fewer cups of coffees and a lower price per coffee going out into the foreseeable future. If we were a listed company that did that, so say we're a chain of coffee shop owners, then we would have to go to the market and say, we paid $1 million for this coffee shop, it's now worth $800,000, and we have to take what's called an impairment of our assets. The accounting rules say if we have an asset on our balance sheet, it has to be valued correctly. And that's important for transparency in the market. So if you're an investor wanting to buy shares in that company, you're not over or underpaying for the assets that are on the books. They're not trying to cheat you by saying, hey, we have lots of assets that are valued at this, when they're not. If you're a bank that's lending money to that company, you've got to have a fair idea of what the assets are worth before you invest. So they have to take what's called an impairment in the coffee shop case we just talked about. And that would be a couple of $100,000. Because of the way bookkeeping works, that would be a cost on the profit and loss, which would reduce.
So it's not on the balance sheet.
The assets on the balance sheet.
Yeah, but then the impairment goes onto the profit and loss.
Correct, yeah.
Oh, okay. I was wondering how that works.
It's double entry bookkeeping, I guess. But but yeah, you've got to do that. That's what's often called an abnormal. So you might see in some company reports every year, here's our underlying profit, and then there are all these abnormals, and some of those are impairment charges. And sometimes the impairment gets written back and it becomes a boost to profit because of that. And Macquarie actually had a couple of those this year where they took impairments on, or what they call credit impairments, and they wrote them back because they didn't need to use them going forward. So anyway, the companies are always adjusting the asset value because of that, and then taking a write down or a write up to their profit and loss. But more importantly, I think that's a once-off cost. So if you're doing a discounted cash flow, straight away, one of the years in that cash flow is not going to have the income you thought it was. But then you say to yourself, okay, well, this coffee shop going forward is worth less, so therefore I'm going to take that off my discounted cash flow. And then if you're an investor, you might say, hang on, this listed coffee shop chain has 50 coffee shops. How many more might be affected by McDonald's opening up in the next 5 years? Let's reduce the valuation on the company based on that. And suddenly, if the share price was $10, it's now $8 because all those discounted cash flows have been reduced based on the one impairment on that one asset.
That was Tony Kynaston from the QAV Investing Podcast. Check out the episode notes for links. There's great discounts available by using the promo code SFB or SFB Lite. Have a look and see if it suits you.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
Sean O'Malley is Chief Editor and Financial Writer for the Investors Podcast Network, the home of the We Study Billionaires podcast. He believes that a company's share price is truly driven by its earnings, and why simply studying Warren Buffett isn't enough to emulate the great one's success. Is this company making money?
Yeah. And I think that is a concept that is very foreign to a lot of people. And they say, no, it doesn't matter if it's making money. It's about whether the price is going to go up, and I'm going to buy it today and sell to somebody at a higher price tomorrow. And, the kind of financial jargon term for that is the greater fool theory, right? Of, you pay a price and then you find some other fool to pay a higher price, and there's no bounded economic reality underpinning sort of what you're doing. And, there's plenty of financial academic literature to back up this kind of very simple statement that I'll say that, a company's share price over the long term is driven by its earnings, and its earnings is a jargony word for its profitability. And so, like I said, whether you're investing in the S&P 500 or you're picking, individual companies, starting from a place of looking at what is just profitable is a surprisingly simple insight that's really all too commonly overlooked. Yeah, it's really shocking. Like you said, somebody will be pitching a mining company or a new tech startup, and it's, they're pre-revenue, but they have this huge market opportunity. And it's like a pre-revenue. I could set up a lemonade stand and be post-revenue. You're investing in something that's pre-revenue. That's really seems incredibly early.
Because a lot of people start taking on some of the nostrums of Buffett and Munger, and they start spouting the quotes, and they think, yes, well, I'm a value investor because now I've used these quaint little sayings that I've heard. But I think you've sort of also seen And especially with We Study Billionaires, because the guys are talking to a whole bunch of people who've made money. And it's like you say, there's all sorts of ways of making money in the markets. And just speak to that for a moment.
Yeah. Well, there's a certain snootiness to value investing, like you said, where you quote these sort of very colloquial things that Buffett would say. And don't get me wrong, I have as much respect for Buffett as, anyone in the world. I went and saw him in Omaha speak with Charlie Munger this year, and it was one of the highlights of my professional career. But at the same time, it does bother me when I see people just kind of throw out these very generic expressions that Buffett may use or maybe even misinterpret the context with which he said it. One interesting thing about Buffett is that the investment that he's made the most money on in his career from a kind of a nominal total amount of dollars perspective is from Apple. And that's a company that many for years would have called a tech company, and he would have, avoided investing in entirely. And so in many ways, he is far more flexible and dynamic of an investor than a lot of people give him credit for. People say he would never invest in tech, and maybe Apple isn't a tech company, but I don't know, they produce a lot of great technology. So Buffett himself has learned and evolved over time. And I'm not telling anyone to go dive into tech stocks that they don't understand, but we do live in a different world. And a lot of, where Buffett started out with was inspired by his mentor, Benjamin Graham, who would do, the expression is cigar butt investing, where you would pick up these stocks on the side of the road that had one puff left, and you'd get the last puff out of them. And they'd be, often companies in dying industries and manufacturing, or maybe even literally the tobacco industry, some dying industry like that. And, they would still have a couple more years of profitability before the industry entirely slipped out underneath them. And you'd buy up those companies and throw off a ton of free cash flows for a couple of years, and you might be able to get some sort of mean reversion, and, you make a few bucks on it. But his start wasn't the sort of long-term, own great high-quality companies for many years that people sort of associate with him now. And so he's had multiple of these inflection points in his career. And I would challenge a lot of the people today who maybe blindly is a harsh word, but sort of blindly follow the teachings of Benjamin Graham and Warren Buffett to consider being as flexible in a rapidly changing world. Adam Cecil, I believe, wrote a book called Value Investing 3.0. And, the very premise of the book is that value investing needs to be updated for the modern world. And when you look at how accounting system works and how companies are valued, a lot of the time that, they'll have these very valuable intangible assets. They'll have all this software and code that they've built up over the years, because some of the nuances of the accounting system, rather than being lasting assets on those companies' balance sheets, those are actually expensed. And so, many of these great companies like Google and Facebook and Apple for a long time looked really expensive on paper because, rather than these investments that they're making in R&D being capitalized on their balance sheet in the same way that a manufacturing company who invests in a warehouse or whatever, the way that might be reflected on its balance sheet over 20 years, a lot of these investments in software were being expensed immediately. It was basically like, it was lost value altogether. So even just there's some failures of the modern accounting system to really capture what companies are worth in the 21st century and how to value this very, digitally native economy that we find ourselves increasingly moving into. So he's been a great influence on me, and I've really enjoyed reading his book. And I think he is probably touching on a very important inflection point. And, again, like I said, I would just encourage a lot of people to be honest about what they don't know and humble about it, and, be willing to be flexible, to think about how the world is changing around them, and, whether extrapolating lessons from the 1940s with Benjamin Graham are still appropriate. And again, there's some incredible fundamental truths that I wouldn't want to disregard or have people overlook. But on the other hand, there's just some technical aspects of markets that are very different now.
That was Sean O'Malley, the Chief Editor and Financial Writer for the Investors Podcast Network. Ed Croft is the founder of Stockopedia. He's done a lot of research into academic papers on investing. He's found that the PEG ratio and factor investing are great tools for smarter stock selection.
So the PEG ratio I got particularly interested in from a great British stock market classic called The Zulu Principle by an author called Jim Slater. And Jim Slater was a great capitalist. He was a great conglomerate capitalist in the 70s. And he eventually actually went I think he might have gone bust in the 80s, but then he made his fortune back writing children's books and then having a column at the Telegraph. And he eventually went on and wrote this fantastic book called The Zulu Principle, which was all about investing in small caps, but using the data to pick really good shares. And Slater's went on and set up Slater Investments, which is now one of the most successful small cap fund managers in London. He's died now, but he was a big inspiration to everything I've done, actually. And I was always a fan of his work. And he really promoted the PEG ratio, which was the price earnings to growth ratio. So one of the first ratios you learn about is the price to earnings ratio. And that's the price divided by the earnings per share. And it's a very, very simple measure of how expensive a share might be against its earnings. So you kind of find that, very expensive shares can be on a PE of 40 to 60 or more, and very cheap shares can be on PE of 3 to 5 or even lower. And of course, where is your buy point? And it's very contextual to know which is the right PE ratio for that stock, because it depends on the growth rate. And a faster growing or higher quality stock would justify a higher valuation. So you might be willing to buy a share on 30 times earnings or more if it's a really high quality, great growth stock. But if it's not growing, you wouldn't. And one of the things that Slater did using the PEG ratio is he divided the PE ratio by the earnings growth rate. And that kind of normalizes that number because, as I said, if the number can be anywhere between 1 and 100 or 200 or whatever, how do you judge it? But if you divide by the growth rate, you could then use the PEG ratio and say, well, look, if the value of the PEG ratio is 1 or less, that means the earnings growth is a higher number than the price earnings ratio. So if you had a company trading on a price earnings ratio of 20 times earnings, but the growth rate was 25% or 30%, the PEG ratio would be less than 1. And of course, if a company was on a lower PE ratio, it could be on a lower growth rate, but the PEG ratio could still similarly be below 1. And he looked for shares that were on a PEG of less than 0.75. And that meant you were buying growth at a reasonable price. And I think that's a very powerful idea. And it's always been a very perennial idea for all investors. If you can buy growth at a reasonable price and do that habitually, you can do well in the market. So that's always a principle that I've had in a lot of my investing, and I've always keep an eye on the PEG ratio. I was going through a complete re-education in what works in investing because I've recognized that a lot of what I learned up to date hadn't necessarily been that beneficial for me, and I dove straight into all the behavioral finance side of it, as well as all of the more quantitative academic aspects of investing, which is something I hadn't got an education in when I was in the city or at Goldman's, but it's something I self-educated on because you started to find there was just so much free publication of academic papers. There are some great stock market classics, and we started weaving all of these key themes and ideas into everything that real ethos and foundation of the service as we started building it up.
So part of the process of putting together Stockopedia was looking at some of the academic research that you referred to before. Yep. And you mentioned factor investing.
The way to understand that, and that's something we actually labeled it as much later as it became a theme in the industry. But ultimately, the way of thinking about it is that shares are driven by certain traits or characteristics that have now sort of become known as factors. But for example, if you were to take the price earnings ratio, the PE ratio we talked about earlier, and sort the market from cheapest to most expensive by that ratio, and you could then chop up the market into buckets. So say you took 5 different buckets from the cheapest to the most expensive, and then track it as a portfolio over time. And you would find if you did that, and then every year you did the same thing, and you moved the cheapest portfolio into the next set of cheapest stocks a year later, because they all change in price individually over the year. And if you track that over time, over the very, very long term, you tend to find that cheaper stocks outperform more expensive stocks. And so that became an idea. One of the most studied ideas was this kind of idea of value investing, or the value factor is a powerful and pervasive and enduring factor in the market. So on almost all of these price ratios where you measure valuation. And this is a common theme all around the world. You find that cheap bucket of shares, and not every year, and in many periods it underperforms, but over the long term, you tend to find that the more inexpensive classes of shares will tend to outperform. So that's kind of the value factor. And then there are other factors. I'll just quickly brief you on them. So the quality factor is looking at the most profitable shares in the market. And again, doing the same thing, sort the market by profitability. And you can look at quality in terms of cash flow, profitability, high margins. Are they self-funding, high return on capital, stable margins, kind of things Warren Buffett really likes. And higher quality shares have a tendency to beat the opposite. I like calling them junk shares, but they're your kind of capital destroying companies. So, or companies that need a lot of capital constantly to keep going. And you find those sorts of shares which are always on a whim and a prayer, and they've got a story. They always have a story. It's that old saying of, there's a lot of mining stocks in Australia, but that old Mark Twain quote of, what's a mine is a hole in the ground with a lyre at the top. But, you find that so often in the market, whether it's you're going after a blue sky technology or some significant resource or whatever it is, but they need so much capital to get to that point of positive cash flow.
And that's why they're on the market, aren't they? They need capital.
Exactly, they do need capital, but it's a bit of a lottery. Yeah. And you find that those types of stocks underperform over the long term, and whereas the high quality ones tend to keep outperforming. And then the last one I kind of focus on is momentum, which is this strange idea that shares that are breaking out or have strong share price strength tend to keep having share price strength. So winning begets winning, and the opposite, losing begets losing. It's a strange phenomenon, but if you were to buy the sort of top 20 stocks by their highest share price strength over the last 12 and 6 months, and you do that every year, you find you tend to outperform. And it's a hugely pervasive phenomenon that most people can't really fathom, but it's based on behavioral biases.
That was Ed Croft, the founder and CEO of Stockopedia. Craig Mercer examines return on equity, a key indicator of how well a company uses its equity to generate profits. I think he's pretty clear in his explanation on return on equity and giving a great example on how to explain it.
I guess I would sort of characterize return on equity somewhat like an onion. At first glance, it's just an onion, but as you sort of begin to look at it in more detail, you're peeling back layers and layers, you come to the realization that actually there's a lot of things that go into understanding, what return on equity is.
Yeah.
At its core, return on equity is simply the return that you get as an equity investor in a company. So, what is return on equity? It's simply calculated as the net income of the company, which is the profits or all the revenues after expenses and the taxes, divided by its shareholder equity. And shareholder equity is simply the assets of the company less all of its liabilities.
So that's like slices of a pizza, I'm assuming. Yeah.
Yeah, exactly.
Each share is a slice of a pizza.
Yeah, exactly, to some extent. So if you think about, say, for example, the real estate market, if you go and buy a property for $1 million and then you're able to rent that property out for, say, $100,000, after all your costs associated with running that, you're going to earn a yield on that property of 10%. So similarly, if you buy a share in a company and it generates a return on equity of, say, 10%, what that translates to is that, say, for $1 million of shareholder equity, which is, again, all of its assets less all of its liabilities, it's generating $100,000 of profit or net income. So you're generating a return on equity of 10% on that company.
Okay, so you mentioned that to calculate ROE, we'll just refer to it as the acronym from now on, is to divide the net income by the value of shareholders' equity. So how do you get those numbers? Where do you find the equity from?
These are numbers that are very readily available. So you can go into any sort of company financial statements and look at both the balance sheet, where you'll find the shareholder equity. And again, if you just look at usually at the bottom of the accounts, you'll have the shareholder equity value, which is again just the assets less the liabilities. And then the net income obviously can come from the income statement. And that again is like profits after tax, or, all of the incomes generated after it's, paid for all of the expenses and taxes. Very easy to find. Any publicly listed company will have to report that information. But you probably don't even have to go to a company's public accounts to find this information. There's, an abundance of, free to use financial websites that will, more often than not just give you the ROE number itself,
Yeah.
but probably reports those kinds of metrics as well, because again, these are publicly available sort of data points. I guess the reason why I say ROE is more like an onion is that as you start to look into it, you can actually start to see that there's many, facets to it. So if you go back to the 1910s, there is a famous chemical company called DuPont, which, is famous for developing things like Kevlar, styrofoam. It still operates today. But back in the 1910s, a salesperson at DuPont was trying to build some sort of efficiency data points for an internal sort of meeting. And this particular salesman developed something called the DuPont analysis, which is he decomposed return on equity into 3 sort of individual sort of component pieces. Now, those component pieces were net profit margin, which is simply, net profit of the company less divided by its sales. Something called asset turnover. The sort of return on assets might be another way to see it's described in both those ways, and that's just sales divided by assets. And then something called the equity multiplier, which is also known as financial leverage, and that's assets over equity. You multiply those 3 things together, and hey presto, you get your return on equity. That methodology is really instructive for a couple of reasons. One is it helps you sort of understand, where there might be inefficiencies in your operations. So it allows you to understand if there are parts of your operations that can be improved upon to boost your return on equity. So, for example, a company might have a very low profit margin. So if it reduces its expenses and sales remain the same, it can boost its profit margin, and that will, have an uplift in ROE. But similarly, you might just increase debt, for example. So financial leverage. If you raise your financial leverage, you'll again have the net, effect of increasing your ROE. Now that allows a business, the management team of a business to understand how efficient they can use their assets to generate returns to you as an equity holder. The very interesting part of doing that sort of decomposition analysis is that when you look at an industry as a whole, and when you're looking at ROE, it's very important to understand what the ROE is for a wider industry so that you have a comparable point of reference. So if an industry, let's just say it's semiconductors, generates on aggregate a 10% ROE, and the company that you're looking at generates a 15% ROE, well, it's generating outsized returns relative to its industry. But on the face of it, that might seem the case, but when you decompose it, you might see, well, actually, this company is simply using more debt on its balance sheet to basically boost its ROE. So its actual profit margins might be comparable or even less than the rest of its peers. So it might not be necessarily making them more money than some of its peers. And that's a very useful part of understanding the returns that you're generating, is where it's actually coming from.
That was Craig Mercer. Have a look at the links for more information about Craig and where he comes from. And to wrap up this episode, we're going to talk to someone who doesn't really believe in the numbers as being the main valuation technique. He provides a cautionary note on the pitfalls of focusing too much on the numbers. He believes in a broader approach to investment analysis that looks at the qualities of a company.
I don't come from a finance background, right? And I think for a lot of people that do, they, particularly you see this with accountants, right? They focus on the numbers, right? But
so you don't agree with that then?
The numbers are only part of the story, right? And you can understand stories by walking into a shop, right? Like One Up on Wall Street, classic book, talked about stockings sold at the supermarket counter in a little egg, right? And because that product was selling like hotcakes, and it was material to the business that owned it, that was a money-making opportunity. That didn't require a spreadsheet, right? That's just required an understanding of what was happening in the world, right? So sometimes when there are big opportunities, yes, it's important to understand the financials, but sometimes they can be so simple as to not be needing that, right? So I think finance probably tends to focus maybe too much on the numbers, and the qualitative, what's the story here? What's the growth prospects? How much does it cost these guys to grow? What kind of returns to expect? How that qualitative mixes together with the quantitative is really important.
Just to define qualitative and quantitative, I've heard it described recently as qualitative is feely and quantitative is numbery.
That's not a bad hack. I might need to think on that one and come back. But I mean, I guess I've never really questioned what makes quantitative. Well, the quantitative bit is easy, right?
Yeah,
that's the numbers, right? So that's the profit and loss statement, the balance sheet, the cash flows, all the ratios that come off the back of that, right? That's the quantitative stuff. The qualitative stuff, I guess, is, what's the business model? What's the strategy? What are the key drivers? Those are the things that you want to understand.
And see, the interesting thing, though, is that using that Peter Lynch model, invest in what you know, it really comes down then to companies that are retailers because you're going to be purchasing products from them, or there might be, say, for example, a business software that you might be exposed to in the course of your day-to-day activities. But then it's not going to give you direct experience of a lot of other businesses that might be very highly investable.
I think Buffett talks about circles of competence, right? So where do you want to start, right? So I think starting where you know, where you've got a fair idea, is probably not a bad place to start, right? And then you can do the research and do the learning and the education piece to start to understand other industries, right? That's kind of how I would suggest perhaps going about it. Yeah. So, and if you did start with, what I was kind of suggesting, where the majority of your money is in an index fund and you're really not taking any swings at that, then you can really focus on the ones where you do understand them. And I think that is important. I think Buffett also talks about, you should have a punt card with 20 slots, right? And you should think very carefully about the slots that you punch when you buy a stock, right? Because you don't get many swings. And if you did that, had that discipline, you'd be a much better investor.
How does that work? I haven't heard about that concept of the...
Well, I think he's trying to say, if over your investing lifetime, you can only buy 20 things, right? When you go to buy something, you have to have real conviction. Hey, I'm using 5% of my purchasing decisions in my life here. This really has to matter, and I really have to have strong conviction and understanding around this, as opposed to this chart's forming a diamond pattern and I'm selling this one and buying that one. I mean, I don't know if you've talked about the stats on traders in this podcast, but most of them lose a lot of money, which is why they have nice businesses and fancy ads. They want more. It's not that far away from gambling.
So presuming that a listener does want to take an interest in researching companies a bit more, what are some of the common ratios that they should learn about before building a portfolio?
Yeah, I mean, I think Howard Marks talks about this among others, is, people are looking for a formula and a number, right? And if it's formulas and numbers, there's a whole army of quantitative analysts out there mining that stuff, right? So it has to be more than that, right? So you need to bring the qualitative understanding to bear as well. Having said that, return on invested capital is one that we particularly use at Morningstar. So for every dollar of capital invested in this business, how much is it going to return you every year? Is it going to return you 10 cents, 10%, or is it going to return you 20% or 50%, or is it going to return you 5%? That's one piece of information, right?
And where can you find that number?
Well, where I would find it is we've got a data product called Data Analysis, which I use religiously. I don't do many things religiously, but that is one. And so I can go to there and use that, but our products will have that. So I think morningstar.com.au, you'll be able to find for specific stocks, you can screen and find things like that.
And invested capital, what does that represent?
It represents the assets of the business, right? So if we're talking about BHP, it's the cost of the trucks, the plant, equipment, the processing plant, what they paid to build the mine, essentially. That would be the invested capital base, which is the denominator in the equation.
Yep.
And the return is kind of the after-tax return after excluding any kind of interest payments, right? So the benefit with using return on invested capital is it says, let's pretend this business is completely ungeared. And why does that matter? Okay, well, if you use a return on equity, what happens is you might have a business that's generating a modest excess return on invested capital, but if you gear it up 5 times, the return on equity looks amazing, right? It could be 20, 30, more percent, right? So if you're using return on equity as a screen, because it's got that financial leverage factor in there, it can lead you into risk taking. So if you're in really good times, right, and you're searching for return on equity, really good times is when these businesses tend to get geared up. The market may be somewhat cautious on these names, so have an understanding of greater than average financial risk. And so they'll show up nicely on a PE. You do a return on equity and PE screen, you're essentially screening for over-geared companies, right? And then, okay, market turns down, it's like, whoa, these are the businesses that are more likely than not to get hit, right?
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.